Welcome to this explainer. So today, we're going to unpack the beating heart of the banking industry. We'll be looking at two terms that are honestly the absolute bedrock of finance: cost of funds and yield on advances. And to do it, we're going to use something we all understand: a simple lemonade stand.
Right off the bat, how do banks actually make money? It sounds like such a basic question, right? But the answer literally holds the key to understanding trillion-dollar global institutions. At the end of the day, it all comes down to the flow of money in and the flow of money out.
To truly grasp the mechanics of high finance without, getting totally lost in all the jargon, let's just picture a 5-year-old running a lemonade stand. You borrow some money to buy lemons, you sell the drinks, and you keep the leftover coins. Keep that simple, shared image in the back of your mind as we scale this whole thing up to Wall Street. Here is our roadmap for today. We'll cover the bank's core loop, define cost of funds, understand yield on advances, look at the magic of the spread, and finally, why the gap matters. We're going to view all these concepts through two distinct lenses: our simple lemonade stand and the rigorous perspective of a senior equity analyst.
Okay, Section 1, the bank's core loop, the spread business. Let's get into it.
Fundamentally, a bank is a spread business. It borrows cheap, it lends dear, and it keeps the gap in between. What's absolutely crucial to realize here is that its balance sheet is completely inverted compared to a normal, say, industrial company. A bank actually owes money to its depositors, making those deposits its liabilities, and it owns money from borrowers, which makes those loans its assets. Kind of flips things on their head, doesn't it?
Whether you're holding pocket money for your little brother at the lemonade stand, or you're raising massive institutional deposits to deploy as high-yield loans like an analyst tracks, the core loop is exactly the same. The whole secret of the banking industry is just capturing the difference in between.
Moving on to Section 2, defining cost of funds, or what the bank pays. So the cost of funds is exactly what it sounds like: the price a bank pays to acquire and hold money from its depositors. Think about why this matters so much. A bank's primary inventory is money. That's a wild concept for a business when you really think about it. They literally rent money. They don't get it for free. They have to pay for the privilege of holding it, and managing this cost is just a relentless daily battle.
You can think of this as the friendship tax at the lemonade stand. You might promise your friends a tiny piece of chocolate just to hold their coins for the afternoon. But for a massive global bank, this translates to the strict, heavily scrutinized interest expenses they pay out on millions of savings and current accounts. It's the massive liability side of the whole operation. And to keep this cost as low as possible, management teams absolutely obsess over a metric called CASA, that stands for Current Account and Savings Account Deposits. This is the cheapest, friendliest money a bank can hold. Current accounts usually pay zero interest, and savings accounts pay, well, very little. This cheap, sticky money is the ultimate way for a bank to drive down its overall cost of funds. In fact, a healthy bank really pushes for a CASR ratio above 40%. The more of this cheap money they hold, the lower their overall cost of funds becomes, which directly widens their profit margin. If CASA erodes, like if that cheap money suddenly leaves for higher-yielding alternatives, funding costs skyrocket, banks panic, and the entire business model really starts to shudder.
All right, Section 3, understanding yield on advances, which is what the bank charges. Yield on advances is the average interest rate the bank charges its borrowers for loans. If cost of funds is the inventory expense, this right here is the earning engine of the bank. It represents the money flowing in, and it's built from a vast array of products. We're talking everything from incredibly safe, low-interest 30-year home mortgages all the way up to high-risk, high-interest, unsecured corporate lending. Back at the lemonade stand, this is simply the price you charge kids buying lemonade on credit. Maybe you charge them an extra coin for letting them drink today and pay you back tomorrow. Well, for a bank, the yield on advances is the vital return generated by deploying those gathered funds into real-world loans. This yield is the fuel that drives the bank's net interest income. It's actually kind of mind-blowing to realize that you, the person watching this, are the ecosystem here. Your savings account is their cost of funds. It's the inventory they're paying for. But your mortgage, your auto loan, or that credit card debt, that is exactly what makes up their yield on advances. You are literally both the supplier and the customer. Which brings us to Section 4, the magic of the spread, the heartbeat of profit. So when these two forces collide, we get what's called the gap. You take the money coming in, your yield on advances, and subtract the money going out, your cost of funds. The result, your net interest margin. You pay less, you charge more, and you keep the difference. It is an elegant, fairly brutal, and highly mathematical loop that dictates whether the institution survives or fails.
Net interest margin, or NIM for short, is that kept gap expressed as a percentage. It's the single most watched profitability metric in all of banking. Really, it's the great equalizer. It shows exactly how well a bank is managing that physical space between what it pays out and what it charges. And because it's a percentage, it allows us to compare a tiny local community bank directly to a massive titan like JP Chase on a totally level playing field.
And finally, Section 5, Why the Gap Matters, or the world outside the stand. The wider macroeconomic environment kind of acts like the strict head teacher of our lemonade stand. The central bank can just step in and change the master dial, known as the repo rate. This instantly impacts how much every single bank pays for its cost of funds and what it can charge for its yield on advances. Factor in things like suddenly changing inflation or a rapid erosion of those cheap cost of funds we talked about, and the math can shift overnight, creating some really intense volatility. The ultimate vulnerability for any bank really comes down to repricing speed. When you hear analysts warn that margins are under pressure, what they mean is that the yield on advances is dropping faster than the cost of funds is falling. If the money a bank charges shrinks faster than the money it pays out, well, that magical gap compresses and massive profits can literally vanish in an instant. So I'll leave you with this. Next time you look at your savings account interest rate, ask yourself, are you their cheapest cost of funds? Seriously, check your banking app today and see if your money is just sitting there helping them widen their highly lucrative spread. Thanks for joining me on this explainer, diving into the real engine of the banking world.